Yeah, I'm Mitchell Baldridge. I'm the co-founder, partner of Better Bookkeeping. Beyond that, I own a business called Baldridge Financial and another business called RE Cosseg. We're in Houston, Texas, and we're here today to talk about better bookkeeping and talk about business accounting, tax planning, and tax preparation for entrepreneurs, solopreneurs, small business owners, hopefully like you. So, Evan, tell them
Yeah.
about you.
Yeah, I'm Evan. I am the COO of Better Bookkeeping. Um, Mitchell does run a couple of businesses, and my focus is really on these kind of solopreneur clients and our own technology that we have to support them. So this is supposed to be educational for you guys, but also we will highlight some of the things that Better Bookkeeping does for our clients. But just in general, you do not have to be a Better Bookkeeping client to find this helpful. We're going to try and give you guys some general principles and things to look out for. And when we do these webinars, we do them generally on a quarterly basis. We try to make them timely to what's happening right now. So you will see some things focused on some of the deadlines, some of the stuff that's coming up as we enter tax season. So let's
Yeah.
go ahead. Oh, and Derek is on the call. He is our CPA at Better Bookkeeping. He will be helping to field any questions happening through Q&A. Q&A is available to you guys, so feel free to ask questions as we go. We will either answer them, on the chat, or we may talk about some of them on the call. So, and then we always leave time at the end if there are any other questions that happen that we want to review. So today we're really focused on 5 moves that turn tax season from chaos to control. If you follow us if you read Mitchell's newsletter, you follow any of the posts that Better Bookkeeping does, we're constantly talking about getting in front of the chaos, getting in front of the bad practices. At Better Bookkeeping, we do bookkeeping all year long. Our tax season is not, 2 deadlines, it's all year. And so these are some of the principles that we like to, make sure that are being followed, just make things a little bit easier.
All right. We got the big disclaimer, which we always break into. This is the my lawyer made me write this kind of slide, but basically, I'm a CPA, I'm a CFP. I may not be your CPA, or I might be your CPA. But this is general advice, or this is not advice. This is general information. Get real advice, get real planning, get real help before you make big dollar decisions. Otherwise, you might hurt yourself. So this is the explosive powered tool in use. So, it- um, yeah. So this is what we're going to talk about today, right? This is the full agenda.
Yeah. So if you followed any of our, like I said, newsletters or things, these are what we've been talking about this season. So, um, the 5 big moves, we like to really focus on your business structure. Do you have the right structure for for your needs, for tax purposes? Is your structure serving your tax self? Keeping your books clean, catching up 2025. We're on March 4th right now. Business returns are due on March 15th, so there's not a lot of time, and so this is going to be talking about some of the scramble. Um, Getting in front of your quarterly payments, understanding some of the different ins and outs for quarterlies, talking about extension strategy. We extend our clients a better bookkeeping. It's a best practice for us just to make sure we have ample time to get everything right. And then, talk through any deductions. I know we get a lot of questions about deductions, what's available to business owners, what's available to non-business owners. So we'll talk through some of those things as well. The idea is that we just want to make sure, as you go into 2026, you're not making the same mistakes you did in 25, and you're setting up yourself up to eliminate the scramble. So getting started, we again love to talk about structure. I always joke with new clients that we're like the Oprah of S-Corps. We love them over here, but they don't make sense for everybody. So um, owning a small business, Mitchell wrote this on Twitter years ago, and it's like his hook that we like love to come back to because it's so um, constant. It's something that we're always going back to because owning a small business is the best tax deal in America. And they keep making it better, which is, we'll talk about that in a little bit. But it's really focused on entity type, what are you doing? How are you set up? And making sure you're set up for success. I had lunch with a good friend of mine last week, and she was talking about how she's a real estate agent, and she's my real estate agent, and I didn't realize that she was a 1099. And we're talking, and she's like, "Yeah, I'm a 1099." And I was like, put my fork down, like, "Are you joking me right now? How much money are you
So,
making?" So it's just something to think a lot about and just get in front of.
ultimately, like our favorite clients that ever walk in. So someone asked the question, "Are we sending out this recording?" We will send this recording out. I accidentally hit answer live instead of replying in line, but yes, we will send this recording out. So you'll get it in the next couple weeks, but or a couple of days. So yeah, ultimately, you know, our favorite client is your friend, the real estate agent, who shows up and just has never even thought about it and just has been making money and doing her best to go sell houses and kind of way, way behind on the eight ball. These always tend to be the best people. They make great money. They they understand enough to know what they don't know, and they're ready to turn it over. Because the good news for somebody like her is, yeah, she will be the Oprah. We're going to hand you an S-Corp. But ultimately, she's so, I didn't, I've never heard this story yet, but I promise you, is so under optimized that like she will walk in and we will more than pay for our fees and more than save her a lot of money and a lot of problems. And she'll no longer have to worry about it. She'll no longer have to do her books. She'll no longer have to do her taxes. We can put her on rails. But just to start, I mean, yeah. So everyone, the big question is like, do I need an LLC? And the answer is, it
Maybe.
depends, like every answer. But ultimately, like, let's just say it's yes. What what could opening an LLC hurt? It costs some money. It's now this like plant in the corner that you have to water. So if you're making $2,000 a year doing voluntary bookkeeping for your church, maybe you don't need an LLC. But once you get into, hey, I'm a realtor and I'm making a couple $100,000 a year, and I'm just getting a 1099 to my personal name. Do I need an LLC? Like for us, it's yes, you do. So let's get this LLC set up. What does an LLC do? Well, lawyers will tell you how it will protect assets and provide this corporate, uh, you know, that's not really what I'm focused on. Today, I'm focused on an LLC can enable you to set up structures that allow you to save taxes. And so this LLC that I set up that I own 100% of for my real estate business, if I do nothing, it becomes a disregarded LLC. So it's almost like it doesn't even exist. But now I have an LLC with a bank account with some kind of corporate veil of protection theoretically. So if someone slips and falls, maybe they sued the company and not me. Again, I would have insurance. So or I would try to have a lawyer and insurance and a lot of things to defray risk. I'm more focused on tax. So then you have the opportunity, or this real estate agent has the opportunity to say, well, should I become an S corp? What does that mean? So yeah, our answer for her is yes. So these businesses that are small business, single one or two owners that are very asset light, that mostly provide consulting, management, kind of work for money services. We put those in S corps pretty often, and you get to the key benefits. QBI optimization, huge benefit. There's this thing that came out in 2017 with the Tax Cuts Jobs Act. It's called the qualified business income deduction. They lowered the corporate tax rate for all corporations from 35% to 21%. And so they threw a bone to the small business owner out there and said, basically, hey, you can get a 20% deduction on all of your qualified business income. So if this realtor made $250,000, was able to deduct 50 and was left with $200,000, she would be able to qualify for this qualified business income deduction, which is 20% of the 200, which is $40,000. But the problem is there are upper bounds of if you're single or if you're married filing joint, how much money you can make and still take that deduction. So the S corp high earners want to set up their W-2 salary in a correct way to be able to optimize this qualified business income deduction so that they can get the max deduction. That's what we do for the high earning folks who walk in, who set up S corps, and there's kind of no limit to what you can save. So, one of my clients, they were making a couple $1 million a year, and they came in and we optimized the qualified business income deduction, and it literally saved him like $200,000. Versus a couple of people, I tweet this thing every year, and every year I get somebody who's like, "Hey, dude, I followed your advice, and it saved me 65 grand." One guy sent me like a Morton's gift card. One guy sent me a big bowling pin. That's what his company makes. So I'll
So
have it somewhere.
let's take a quick step back and let's just we have a slide here and I want to make sure
Yeah.
we're not causing chaos in your brain.
Oh, how
So
dare you?
yeah, not you,
But
for our audience, but let me just really quickly.
yeah.
So there's four blocks on here. So we talk about sole prop and LLC. So basically this is, I went in and created either I didn't even create an LLC, I just did some work and someone paid me, or I created an LLC and it's just sitting on my personal tax return. So both of those sit on your personal tax return. Those are like low energy. Either I didn't do anything and someone just gave me some money and I had to report it on my tax return, or I went in and went through the exercise of creating an LLC. We spend a lot of time talking to our clients about when they should move to the next level. Should they become an S corp? Does that make sense? It's still an LLC. You can also have a partnership, which is still an LLC. It's just a partnership, as an LLC. It requires a separate tax return. The other,
Basically, if you have the sole, like if your realtor friend had a partner
Mhm.
in the LLC, or frankly, if she had a partner and they didn't even have an LLC, that would be a partnership. So a partnership is an LLC that has more than two owners, that isn't an S corp or a C corp.
Yep. And then people do, which is not our favorite practice, do sometimes elect to make partnerships S corps. Don't love that because it adds a lot of complexity that we prefer for S corps to be one to one. One person owns an S corp. There's a lot of nuances
Oh,
in this, and we can talk more about it. But I just want you guys to understand that these are not specifically entity types. These are just kind of different ways to look at your taxes. They're different tax returns. And then, of course, the C corp is totally separate. It's a proper business return. It's its own world. It's not, on in your personal name at all. And so we navigate this with our clients all the time of like, where should they be using what and why? Um, but always, if you're making more than, my rule of thumb is if you're making more than $70,000 of net profit, so profit that actually hits your bank, an S corp is going to save you money.
yeah,
And
it's starting to get into that area where, especially if if you're going to make 70K for the rest of your life, you can flip a coin, but ultimately, as you're growing, that becomes that break point for sure.
yeah,
And that the S corp downside is like you should not own real estate. It's hard to kind of get out of it, and when you have real assets that get stuck in an S corp, it's not flexible. Like a partnership, you're free to put stuff in, you can pull stuff out, you can add partners, you can buy out partners, you can do a lot of things with a partnership that are kind of non-taxable transactions. When things get stuck into an S corp and then you bust a S corp election, it becomes a C corp, and then you have built-in gains and you have dividends and you have all these issues of trying to get things out. And then the C corp is really useful if you're raising money or you're high growth or you want qualified small business stock, the QSBS exemption. Like So we work with clients and advise clients in detail and why they should or shouldn't pick kind of all of these different
Yeah.
things. So that
Pro
none of this
con,
is a
yeah. And the other thing is that we have a lot of clients that like, oh, my wife has a pottery business and it hasn't taken off yet, but she's has a lot of pre-sales and I think this is going to be her year. Cool. Let's just wait. Let's watch it. If she starts making money this year when it becomes actually worth being an S-Corp, we can make that choice. So, these are just things for you for we want to talk about the different options here, but we're constantly advising our clients on what is the right structure. Back to my realtor friend, she should be an S corp. She's under optimized and when she first I was like go get an LLC. She doesn't even have an LLC. So she's working on that step 1. Um but we'll save her a decent amount of money by making this change because it really does and it's forever money saved because once you make these elections and you start doing these things it ends up saving you decent money as you go.
you save the money every year in perpetuity. Um,
One thing that also I talk a lot about this the S corp and the I call it the PETA tax because an S corp's a pain in the ass. Like you save yourself money, but you have to set up a salary. You have to um, go in and have a separate tax return for as long as that S corp exists. It's totally it's not hard. It's just one more thing you have to do. And I know in the world of there's just a lot of things to do, it's not always great to put one more on your list. Um, we think a lot about, so I get a lot of times when I talk to new clients, they're like, oh yeah, I've been paying myself a salary. And I'm like, okay, well, what payroll provider are you using? And they're like, no, 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 I'm just like giving myself 10 grand a month. That's a distribution. That is not a salary. A salary is something that actually runs through your payroll provider. It is hitting all of the tax, appropriate agencies. Either it's going to the IRS or going to your state. It's doing all the different things you got to do. There's different forms that go out. And we generally are not telling you if you made 200 grand this year, if that's what you're going to make, we don't say give yourself a $200,000 salary. We look at a reasonable salary. We look to try and make sure your QBI, that qualified business income that Mitchell was talking about, is optimized. And that that you're actually doing the things you need to with that salary. It is a requirement to not have to pay self-employment tax. So that salary is a necessary thing that you have to do for an S corp. And so we do spend a lot of time with our clients trying to get that right. Um, we also use the
yes.
salary. Oh, go ahead, Mitch.
Oh, well, we use a third-party payroll provider, but 99% of our clients use Gusto. And I've been a Gusto's not perfect, but I've used Gusto to kind of outsource salary and payroll taxes for at least 10 years. And just the idea of when you pay salary and you're in Milwaukee, Wisconsin, you have to pay your county and your state and some locality, and then you have to pay the IRS. And uh, all of these agencies get really, really, really upset if you pay salaries and you don't withhold your taxes timely. They consider all these withholdings and remittances their money, and so even beyond, if you don't file your tax return and you're late, they'll charge you penalties and interest. Like if you don't pay payroll taxes, these agencies get very, very upset. So I've always outsourced payroll in the sense that like this is not a DIY thing. This is not like get on Chat GPT and figure out your payroll taxes because if you mess it up, it will cost you more than what it would have cost you for 10 years to just pay Gusto to take care of it. So,
I had a client join when they joined. He was like, "Yeah, I had a lady come to my door," and I was like, "What lady?" And he was like, "She was like from the IRS. She was a payroll lady," and I was like, "Are you joking me?" She wanted his 940 and 941s, like, and it was wild because I was like, "They really." He wasn't getting audited. He was just getting a knock, I guess, and he started paying himself on a I guess a monthly basis or every 2 weeks, and she's gone now. So, um,
wow.
A few different things just to note on here. So the salary, a few different ways people use salary as well, which I find super helpful. Um, Sometimes people will overwrite their withholding, so it's a good way to, as a small business owner, you have to pay quarterly taxes. We're going to talk more about that in a little bit. But some of our clients use it as a withholding tool to limit how much quarterly tax they have to pay and get in front of it. Money never hits their bank. They never see it. They never miss it. Um, and then also, making sure you know how much money you're going to be making, month over month, week over week. So, having a W-2, we have a new client who has always had a W-2 and now he's in 1099 world. And he's just like, I don't know what to do. I don't know how to like budget myself. I don't know how much money to expect. I don't know how much money to pay. So we're using his W-2 as a way to help guardrail a little bit of that. So just those are some little best practices to keep in mind. But some of our clients just are like, I'm going to pay myself, minimum, whatever, and then I'm not going to worry about it. But these are just some things to keep in mind. Um,
So with these S corps, they're either paying low salaries to justify the idea that they have a salary and that they're being compliant with payroll taxes, or they're generally paying relatively high salaries to qualify for QBI, or they're paying somewhere in the middle to try to optimize 401k plans or other kind of one-off issues. But I generally with S corp see people like playing poor or playing rich. These are the two kind of like break points that I think about. So sorry, the case study. Here's your realtor friend who makes $400,000. Let's go.
Yeah, so same 400 grand, same $40,000 in business expenses. The net is the same. The difference is with a LLC, there's no salary being paid. So there's a lot more self-employment tax. There's this $32,000 of self-employment tax. On the S Corp, they are paying instead $150,000 of salary. And so that means the net amount, the rest that, that's left um, for distribution is what we're calling it here, but it's 210,000. And so you're paying that self-employment tax in with when you have an S corp, it's actually more of a payroll tax, but that number is much smaller. There's less income that is being kind of put in here, and you're not having to pay self-employment tax on that full $360,000. So we're saving $7,000 in self-employment tax. We've also, have this QBI optimization, so of $16,800. So the total savings we're showing just by just switching to an S corp is around 24 grand, and that's just from moving from having an LLC to an S corp. And then if that goes on, we're saying the 10-year impact of that, if you're making 7% more year over year, is this, it's not inconsequential. These are rough numbers. On the next slide, I'm going to show you, we have an S corp calculator where you can go play with putting in different salaries, put in different total amounts um, earned, and it's a good way to just see when does it make sense to be an S corp. Um, but it's good to consider, and this is why we're always like giving out S corp as a proper tax advice.
Good. We got the calculator little QR code. Someone snap onto that. But we have this great little nifty calculator we built that allows you to kind of work your way through this. So
So rule of thumb, if you're making over 60 or 70 grand in profit, net profit, the S Corp election is worth exploring. Um, People don't like to do it because payroll is annoying. They don't know what a reasonable salary is. They don't really understand the QBI optimization. They don't really get what the difference is between a salary and distributions and what self-employment tax does. So um, we don't have to beat a dead horse, but check out the S Corp calculator and see if it makes sense for you. And you can always reach out to us and we can help you, to confirm whether or not this is a route you should take. Um, so just as a real quick recap about some of the stuff we talked about, do we need an LLC? Maybe, of course. If you want to, it's great for limiting exposure for your business versus personal. But for tax savings, it's also the first step to moving towards a potential S corp. We refer people to Better Legal all the time. to set up an LLC because it's simple. There's also LegalZoom and your local attorney, whomever. Setting up an LLC is not hard. So that's an easy first step. You do not have to do it in Delaware. I don't know why everybody always wants to do it in Delaware. It's great for,
Wyoming.
yeah,
Yeah.
Wyoming's a good one, but Delaware is like one of the most expensive annual license fees. So I would suggest not Delaware unless you're doing a C Corp, in which case, that's generally the golden standard. Um, Taking an S election is flexible. You should do it, when it starts to feel like you're going to have a profitable business, it's going to continue to be profitable. If you think this is a one and done, the juice may not be worth the squeeze. But if you're thinking I'm going to be running this business for a while and want to continue to grow, we file the 2553 form, which is the S election form for our clients kind of throughout the year, and we do it when it makes sense for them. I'm going to let Mitchell talk about qualified business income deduction because it's a mouthful.
Well, I did kind of, but yeah, it's this, you know, deduction that you get out there for business owners. They tried to cut us a break. And so again, we're trying to optimize salary around it based on whether you're one of these specialty service trade businesses like lawyers, doctors, accountants, certain uh, famous people that they aren't eligible for it, but kind of most businesses can get 20% of their earnings deducted. And so it's about optimizing salaries to kind of make that be able to happen out there. And by the way, we do have this Q&A open. So if you have any questions or if we're talking too fast or whatever's happening, we can help you now. And if it kind of extends above and beyond the scope of this call, either Derek will reply or we can get back with you over email.
Okay, we're going to move on. Catch up your 2025 books before you file. Um, we preach to the choir on this one all the time because messy books are really challenging. We get a lot of clients who are coming from QuickBooks who are living in this messy book world, and it's really hard you cannot file a tax return if your books aren't clean. So, um, we look at things where people haven't categorized their accounts. They have everything kind of lumped into one bucket. They're using one credit card across their business and personal, which means that it's unsure if that trip to Costco was an office expense or a personal expense.
One of my favorite tweets I ever did was like 95% of business accounting is just making sure your kid's haircut comes from the right credit card. And yeah, this idea that Evan just touched on it. When people have good compartmentalization or good boundaries around card spend, that there are clients of ours where when they have the Costco trip or they have the gas bill, we don't know what to do with it. And then there's clients of ours where if it says, you know, blah 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 toy store, I would assume it's business because they're so rigorous about how they use their card that even something that didn't sound right, I would just assume was a business expense. So
Yeah.
the idea of just getting your LLC set up, a bank account set up, use Ramp or use Chase Inc. Business or go use the Delta Sky Miles or whatever credit card you want, and just having that stack just be locked down, airtight. You're gonna run your business appropriately from this structure. Solves so many problems in business and makes catching up or getting on track or figuring everything out really, really simple.
Yeah, I mean, our system is set up that you connect your bank accounts and credit cards into our UI, and then we just have all the transactions at our fingertips, and we go in and categorize them. And for the clients who do have messy, or don't have, as black and white between their personal and their business, we err on the side of what makes the most sense. And so they probably are missing things. Like we don't give them the grocery store as a business expense. We put that as a personal expense. Like If you are very, very crystal clear with your books and how with your cards and how you use them, um, we're not an audit police. We're here to follow your lead, and we obviously give advice on and direction on what should be classified as business. But if you have an office party and you pay for things, like we can expense those. But if we don't know that because everything's messy, it makes it a lot harder for us to do our job. I had a new client join at the end of the year before last, and um, he didn't have anything set up. He didn't have an LLC. He didn't have a business bank account, and we were trying to do his taxes for the prior year. And they had so many different cards across so many different worlds, and by the end of it, he was just like, forget it. I don't want to even look through this anymore. It's not worth the cost of trying to go find these expenses at this point. I'm exhausted. I have a full-time job. And we tried our best to get his books as close as we could, but it just there was too many things in the mix. And so I guarantee you that there was a lot of deductions left on the table. So we love to talk about making sure your books are caught up, make sure everything is clean. We have, we do this every month I mean, every day, frankly, for our clients, but make
Yes.
sure the business income is being categorized correctly, that expenses are in the right place, personal business is in the right spot, everything's separated, that we understand your loans between principal and interest because they set different places on your tax return, mileage where it's needed, home office deduction. We do home office deductions for probably 99% of our clients because of the nature of their businesses. And then the contractors are being tracked correctly. That's also another one that's just a nightmare at the end of the year. If you're paying a contractor through Zelle and then you pay them through a check, and then you're like, oh, cool, I'll do a Bank of America transfer. We just try to make sure there's continuity and that, we're helping to keep all these things on the rails because you miss it. Like we had a client who paid a contractor out of his personal bank account and was like, "Oh, I paid him his 1099's wrong." And we're
Yeah.
like,
Why'd you miss that? Yeah, exactly. You're like,
not a
what?
magician.
Uh,
So we do our best from the better bookkeeping side to make sure we're helping, get everything in the right place. And but just thinking about it this way and getting your brain thinking about how, is this a business expense? What should I be doing? It's really a good practice to be following.
yeah, and we'll talk more. Here we go, right into we're still catching up people from last year, and we'll be catching up people from last year all the way through
October.
probably 2 years from now. But
Yeah.
ultimately, we take some messy cases with long backlog filing history or non-filing histories, but really, yeah, we're catching up. January through December of 2025, all the way through October of 2026, and then we want you to feel that feeling of what it's like to be caught up, so that you never get behind ever again. And one of the coolest things we've done, Evan, is like we do take people who are like, "Hey, I've never been on top of this my whole life," and they do finally get that feeling of just like, "Oh, I'm caught up, and this works, and this is just really awesome." And like
I,
this can be such a mess for people, or this can just really, really be a big mental block for people, and it's
yeah,
cool
I
when we
get
get
I get the a question a lot during like our sales calls of how often do I talk to me or Derek or a team? And I'm like, well, you can talk to me whenever you want. But the thing is that you're not going to want to talk to me after we get this figured out. You're going to be done. You're going to be like, cool. I don't have to talk to my person because they understand my books, they understand my life, and they're telling me when to pay quarterlies, when to pay attention to things. And the proactive versus reactive definitely, I know, has freed up a lot of mental space for a lot of our clients who feel a lot of stress and shame, frankly, about having messy books and lives. I get the mine are the worst books you're going to ever see, and I'm like, I promise you, I've seen
every
worse.
so often you're like, yeah, you're right, but
Maybe you're terrible. Um, so I think just things to think about, our best practices are feeling rushed versus feeling ready, gathering receipts in March, personal cards. We've already talked about all this stuff. Estimated numbers. I think I paid this guy this amount of money. You end up just going ahead and just filing it. I get that, a lot from folks, or I'll talk to people who said last year I just had to get it done versus, having current books, being able to see what your books look like throughout the year, understand what your profit margin truly is, understand where your money's going. You can file with confidence and then you can keep more of what you earn because you know what you're doing.
Yeah, that's the other big, yeah, this thing we do for folks where just every quarter, because all the books are caught up, I, when you get way, way, way behind and you're never caught up, you lose like probably 80% of the value of what we can do for you, which is you can always have kind of a good idea of cash balance and P&L and tax due. You can kind of see how your business operates in real time. You can go, oh, look at the last few months. Oh, look at this expense that is creeping up and creeping up. Whereas, if we're sitting there in July and preparing last February's P&L, there's just like nothing you can really do with that. And so, yeah, by closing out February on March 10th, by closing out March on April 10th, we get to in the middle of April go, hey, this is your quarterly estimated payment. You need to pay this to the IRS. You need to pay this to New York or Pennsylvania or whatever. Write these two checks, and you just get to go operate with the confidence of going, okay, now everything that's left is my money, and I don't have to worry that I have this big boogeyman payment due that I haven't really paid attention to. You know?
I feel a lot of times that business owners are shocked that they have to pay taxes quarterly. Um, and that's one of those things where it's like, I'll be on calls as a small business owner. You need to be paying taxes on a quarterly basis, and sometimes I'll get people being like, "Oh, I don't pay quarterly taxes," and I'm like, "Well, what are your penalties? Like, what are you looking at?" And I think, a few years ago, the interest rate was way lower and it wasn't a big deal. And I think people would just kind of keep their money in the market. They're like, I can make more in the market to cover the penalties and interest than if I went ahead and paid the IRS on time. But the rate is growing. It's, 8% now. And so that isn't depending on how much money you owe the IRS, it can be a consequential number. And so it's what I always say is that we're just going to at least tell you what that number is, and you can make the choice on what you want to do with it. Um, Common mistakes we see are people don't pay at all. So
Yeah.
that's the most common is, oh yeah, I didn't pay. I didn't know what I was supposed to do. Um, Maybe they pay the same amount. Maybe an accountant gave them a number, 2 or 3 years ago, and they're just paying that number like lockstep every month. Like, oh, I pay 10 every quarter, I pay 10 grand. Well,
Hang on vibes. Yeah.
yeah. They are looking at last year's number and going, okay, I'm just going to pay what I paid last year, or they're just going to guess and feel like they should pay this amount. And so what it just leads to surprises and being ill prepared and not really knowing, what's going to happen. And really, well, we're always trying to put in systems to make sure you do know and that you aren't surprised. And then you can make choices. And that's always like what I tell our clients is like, at least you can know what your choice is.
Yeah. And so, like, a little bit about estimated tax payments, like the structure is basically you have to pay all your taxes by April 15th, right? We all know this, and you can extend until October 15th for your personal return, but your taxes are due April 15th. But before that, January, September, June, and the prior April, you were supposed to pay these quarterly estimated payments for the taxes along the way that you accrued. And so there's a couple of ways to determine what those taxes should be. It's either the actual amount you're going to owe, and you need to pay within about 10% of that actual amount, or you can do this thing called safe harbor, which means you can just pay somewhere between 90 and 110% of the prior year. So if I, it's March 4th today, if I hit the Powerball today and I make $1 billion, I just have to know what my 2025 taxes are, and I have to pay 110% of that until next April, when I then need to pay, $400 million. But so if your income's going up and up and up and up and up, it's great because you can generally just safe harbor to last year. You can say, well, I'm going to pay last year plus 10%, and I'm going to keep that cycle going. But you still need to know every April what you're going to need to top up and to pay the first quarter of next year. And so there's just, what we do for our clients is just tell them the number. We run the calculation ourselves and we say, hey, here's what you should pay. And then they go, well, I don't want to pay that. And you're like, well, you kind of got to, because here's why. And
Yeah.
so
And well, so this is just, we're going to talk about safe harbor on the next slide in more detail and
good.
explain
Oh,
exactly what
sorry.
it
I
is. That's
cut
okay.
you off.
Yeah, but the just to keep in mind under payment penalties, like that they can compound, it's not massive money, but as you can see, 100 $360, not huge, but that continues to grow month over month, quarter over quarter. So it can end up being, 2,000, 5,000, depending on how much you owe. So just keeping that in mind that the penalties aren't insignificant anymore.
Yeah.
But this is what we talk about. There's a few different ways to define what your quarterly number is. The safest one is safe harbor. We use
Sure.
three. We're going to talk about the other two on the next page, but this is what Mitchell was talking about. Either you pay 100% of what you paid last year if your AGI is under 150,000. If you make more than that, then you need to be paying at least 110% of what you made the prior year. That's just like a safe number. You can just make that and then divide by four, pay that on a quarterly basis, and Bob's your uncle. Like easy peasy. Um, it also means if you go and win the Powerball and make $1 billion, you can still pay 110% of what you made last year divided by four and no penalties and interest. You still have to pay the remaining balance in April. You still have to pay, you have to still pay your tax. But this just means you're not going to get extra stupid penalties for not paying throughout the year. But then we have people who um, maybe you're having a down year, and that happens. Not every year is going to be like, knock it out of the park. So there are a couple other options beyond 110% for how we look at doing your taxes throughout the year. You can also go in and take 90% of the current tax year. So if last year you knew you were going to make more money, you can at least pay, as long as you pay at least 90% of the current tax year. Um, Now, of course, you need actual performance. You need real numbers here. These are things that are not quite as, here it's easy peasy. I'm just going to take this number, divide by four, and pay it out. Um, or the other thing we do for most of our clients is the annualized income method. So look at actual earnings and annualize those throughout the year, and then you pay your quarterlies based on the true numbers that are happening in your system. This requires clean books. This requires you to know how much money you're really making, and that you're not, that you haven't had like random contractor payments out of a different bank account. This all needs to come. I mean, this is requiring you to have, more accurate information. This is why we can do this for our clients, is because we have actuals throughout the year. So safe harbor, bare minimum, easy peasy. You can at least know, what did I pay last year? Do either 100 or 100%, 10% of that. Um, but then there's a couple of other options here just to make sure you stay on top of it. Mitchell mentioned these deadlines, but next
Yep.
deadline to note, April 15th. The thing that sucks about the April 15th deadline is you have to pay the rest of your balance from 2025, and you have to pay your Q1 balance. So this one's a bit of a doozy, especially if you didn't pay your quarterlies last year. So
Big one. Yeah,
yeah,
that's the one where every once in a while you send the note saying, "Hey, you need to pay all of your 2025 and the first quarter of 2026. Let me know if you have any questions. And they're like, yeah, where am I going to get all that money? You're
Yeah,
like,
let
well,
me just
I don't know.
pull 30 grand out of thin air. If you pay quarterly, when you come to April 15th, you're just paying Q1 because you've already paid the rest of the balance from, maybe you have a little bit of balance left over that didn't pay from the year prior, but it hopefully shouldn't be like a knock in the teeth if you're doing this right. But yeah, it can be a bit of a challenge. And we do have clients that, they get caught up and they finally get up to date and then this becomes a new practice for them, but it's obviously very easy for us to be like pay quarterly. In actuality, I know it's not always the best. So I kind of alluded to this on the other page, but the annual only approach, if you just do things once a year and you talk to your accountant once a year, you give them your books once a year, you may owe 30 grand. You have to then be shocked that you owe 30 grand. You got to figure out how to pay it. Maybe you have to go get on a payment plan with the IRS. It's just, if it's a guessing game all the time, you just kind of I feel like that's the biggest thing I hear from our clients is like, man, I'm super stressed about this because I don't know how I got here and I don't know how to get out of this. And we always just, if you know your tax liability monthly, you pay your quarterlies, you understand with like real data of what's going on, then you're not going to be, shocked and scrambling at the end of the year. So clean books, better taxes, just make sure you know what's going on and then it takes all the guesswork out.
I had a real estate broker guy who's a real high earner who owns a bunch of real estate property who, just said, look, yeah, I just wait to pay in October. I pay the fees, it's whatever. And yeah, that was one of the things where I go, you're probably paying like 8% interest on everything you owe to not pay in April. Like I just want you to know that. And that was news to him. I think everyone got kind of lulled to sleep in this low interest regime of the IRS where now these are real numbers and it's real carrying cost to not be paid up on time. And even the guy who kind of enjoyed the idea that he was getting this arbitrage on his money realized, oh man, no, that's not that's not going to work for me. I need to pay up. I need to get squared up, you know.
And it is funny because we still have a lot of clients who are like, you extended me, so I have until October 15th to pay my taxes. And and the answer is no. You still have to pay your estimated the taxes that you owe by April 15th. And it's interesting because we extend as a rule, we extend our clients. And here's why. But we extend folks because of a lot of them have K-1s. They're waiting on other taxes to be filed from other people, providers, and other business deals they have going on. So that's a slam dunk of why you would need an extension. But we extend all of our clients because it means we have more leg room, more breathing room to get things right. We finalize books, in January and February. The filing date for S-Corps is March 15th. So that's a quick turnaround to just make sure that all the I's are dotted and the T's are crossed. We're spending our time right now, this season today, for us is working on extensions and working on extension payments. We're doing 90% of the taxes to get all the numbers right and get all that information in so that your actual the taxes that are being paid to the IRS and the state is correct. But waiting for the charitable donations, waiting for um, getting your 1098 mortgage statement, like trying to get all these different documents and everything in, it can take time and things can get missed. And so we like to make sure that we extend, it gives you the ability to then not have to file amendments, not have to redo things later. And then also if you extend, then you don't have any late filing, penalties or any fees that come up. So you still have time to maximize retirement contributions. Sometimes people are cash strapped, they don't have enough cash to make these contributions at the beginning of the year. So, you have to just pay it by the time that your taxes are filed. And make sure you have plenty of time to go back through your books, especially for people. we extend all of our new clients, especially because we want to make sure they have time to go back through their expenses. Did we get everything? And then of course, just making sure QBI is optimized. That's moving forward more than we can't really undo too much in the back, but we just want to make sure there's plenty of time to have all these things in place. But again, you still have to pay your taxes by April 15th. Um,
So yeah, I think a lot of people do just want to get everything done the first of the year, and we work with those people. Like if that's you and that's who you want to be, we have clients like that, and we have a
yep.
space for you. But it's March 4th now. If you want to sign up right now, we're
Nope.
probably going to extend you and file you, and we're going to do our best to get you extended by March 15th, get you extended by April 15th, get you a payment, get you on the road, and we'll get you filed in June. Just get us everything we need. Um,
Yeah, but there's still some things you can do even if you do extend. You can, like I mentioned,
Certainly.
there's some funding. Some of the funding needs to be done.
Yeah,
Um,
the IRA, the traditional IRA and the HSA have to be done by April 15th. Those can't be extended. The payment has to be made by April 15th. The payment cannot be extended. So you need to get your head around what that check needs to look like. But really, most of the business stuff gets to wait until September and October 15th, the extended business deadline and the extended personal deadline, where you can do the big SEP, you could do the big solo 401k. Well, you can't do a solo 401k. That had to be set up last year. But or
you can
yeah,
set
you
up
have
the
but
funding.
you can get that squared up, but then and you can't fix your QBI for this is a problem, and we have this every November. We have the things we get to tell you in November we that we don't want to tell you, or the call we have in February that we wish we would have had in November. And here we are, and it's February, and we're just dealing with February problems. So some of this optimization, this is a tough time of year because folks come to us and say, "Oh, great, you're going to save me $40,000, and you're going to save me $40,000 every year in perpetuity." And we go, "Yeah." And he goes, "Well, what about last year? And what about the year before that?" And you go, "It's over, man. Time goes one direction. We're looking forward, but that
Yeah,
is where we're at."
nothing hurts my heart more than when someone doesn't even have an LLC because, sometimes you can try to do late elections for things,
Yeah.
but you can't late elect an LLC. You cannot late pay a salary. Once December 31st comes around, like you cannot go back and reissue a W-2 or do something like that. And you cannot create an LLC after, the date is the date. So if you think your business is going to do well, get an LLC. It's cheap. Like it's not hard. It's low hanging fruit, easy things to do. Because without that LLC, we've had to tell some folks you will be great going forward, but I'm sorry your past year is just we got to call it a sunk cost because there's not a whole lot we can do.
Yeah. And it's better to we try to go back as far as we can and help as much as we can, but ultimately there's a lot of savings in the future. The best time to get sorted out is the day you first needed to, but here we are. So let's go.
So some of the deductions and things like, we've been talking about what is your personal card versus business and keeping those as church and state as possible. I was talking about church and state with a guy from London the other day, and I was like, "Oh, does that make sense to you?" Um, I use that phrase all the time. But anyway, so first and foremost, let's talk about the one beautiful bill. I think Mitchell mentioned this at the beginning. It was big and beautiful from a tax savings perspective. So some of these things, these are some of the standouts that happened when it came to deductions and some of the things that you need to keep in mind for tax savings, tax purposes.
So yeah, I mean the one big beautiful bill, we did a big webinar on that. We talked a lot about that. brought in 100% bonus and fixed R&D and did all this stuff at the corporate level. But what it did for individual tax returns is, gave you a bigger standard deduction, just kind of eliminated exemptions altogether forever, but brought in these new ideas of auto loan interest deduction, expanded salt caps, and different kind of things to do with the pass-through entity tax deduction for folks who live in high uh,
State tax.
state income tax states. And then the other thing that happened was we had the no tax on tips, no tax on overtime, no tax on Social Security, which those are all in name only. These things that were designed to kind of push down taxes on those items, especially the Social Security one. But you know, uh, all have their own special phase outs and their special ways that they're being implemented. So if you're in a situation where you earn less than 100, 150,000 if you're single, or 200,000, 250 if you're married, maybe even some of those go up to 300, and you earn tips or you earn overtime or you're over the age of you're collecting Social Security, you may want to look into how that's supposed to be rolled out, because it's just all these tax preparers are learning a new regime on the fly, and this is the first tax season where all this stuff is getting pushed out, so everyone's figuring out the rules as they go. It's not really like these aren't really uh better bookkeeping specific issues, but they're very good to flag, and there's stuff that we consider for everybody, but just generally the phase outs are low enough that our clients tend to fall out of these issues. We deal with salt and PTET all the time, but that
Yeah.
hasn't really changed for us,
We really just listed here the ones that are the most important for our client base. There are tons and there's more. But salt is the
There's
biggest.
infinity tax changes forever.
It's a lot.
Yeah.
And we also are heading towards the end of our hour. And apologies, I guess we've been just yammering a little bit more
Oh,
than
we've been just
usual.
kibitzing. Yeah,
Yeah.
perfect.
So we'll try to get through. If you do have any questions, go ahead and throw them in the Q&A and we'll make sure we get to them. We only have a couple more slides left, so um, we can just talk kind of at a high level. The last couple things are just the common deductions for businesses that people leave on the table. I mentioned home office deduction. There's, kind of simplified math, and then there's actual expense method. We do the actual expense method with our clients for the most part, just because we make sure that the savings are actually based on what they're doing. You can also just kind of wing that and give an estimate. But we like I said, do home office deduction for most of our clients. People are always shocked that if you have a a phone line that you use for work, or your internet is using for work, or I mean all of your software subscriptions, like anything you're using, if you're reading something that you're using for your business, like a lot of times New York Times, maybe you're using that for just gathering information. Any computer
That
equipment, that stuff feels very obvious. Go ahead, Mitch.
well, that you'll read on TikTok that you can deduct your watch as marketing or your haircuts, and like we're not talking about that. We're talking about bona fide business expenses that are ordinary and necessary to run your business. And like I used to work for an accounting firm. I'd drive to work. I'd sit in my cubicle. I'd do my business. It was a different time. It was a simpler time. But the day I left that job and hung up my own shingle, all the kind of uh, laptop and automobile business use and cell phone business use and professional development stuff that I wasn't being reimbursed for, but I couldn't deduct, all became deductible. And so, again, it goes back to the compartmentalization of having the business bank account, having the business credit card, taking those expenses the right way. And then all we're worried about for our clients is what would ordinarily fall outside of your business checking account that we need to worry about: vehicle usage, home office usage, and then, some coaching we do for our clients is just telling them, hey, here's everything you can deduct. I had a doctor client just one day go, Mitchell, you need to send me a long email and just tell me absolutely everything I can deduct. And we try to educate our clients on that. For some people, it's like more than you think, and then for others, it's less than you think,
Yeah,
and you know who
the
you
less than
are.
you think. Yeah, the less than you think ones are interesting. I feel like I burst some bubbles every now and then,
Yeah,
but like courses, certifications, coaching, if you're a business coach, stuff like that, people don't always think that they can deduct it, and you definitely should. Here's just a quick, and we'll send this out. Here's a quick list of some of our these are our categories in our system, that are definitely things you should be making sure you're expensing. Um, Marketing, all that kind of anything you're doing from a marketing perspective, vehicles, equipment training, obviously employee costs, things that you're doing to WeWork, or kind of any shared space that you're doing office work at. These things in some ways feel obvious, but it's good to have is that on my business card? That's a lot of the time the question that I find folks and asking. They're like, I
yeah.
think, oh, you know what? I don't have that on my business card. I'm paying for that, but I'm not paying for it on my business card. So this may not be a new list to you, but it would be good for you to mentally go through and go, is all of this on my business card? Because it may not be, and that would be a good place for you to look. Um, quick thing, if you could always just, if you aren't currently breaking things out, this is how we tell people to get started. And we do this for our clients that are new. We have them connect their personal cards into our system, and we
Yeah.
help going and look for these categories. This is exactly what I do for new clients who have not been following our best practices. And I go in and give them a list and say, here are the categories that potentially could have business expenses. And then I have them tell me yes or no. And but this is a good place to start with your American Express bill or whatever, and just go in, add them all up, and then get a software to do it for you and never do it again, because you'll hate yourself when this is done, but hopefully you'll save yourself a lot in expenses and things that you can deduct.
I mean, in the age of AI, you can now take all your personal bills and just dump it in there and try to tell it to tell you. And look, in the age of AI, you can probably just get Claude to do all your books for you one day. But wait, I had a good call yesterday with the architect, and I he said, "Oh, well, what do you think about AI?" We were just talking about AI, and I was like, "Man, AI is not going to tell me how to be an architect, and it's not going to tell you how to be an accountant. I can use AI along the way of like our building project together, but it's still just not going to get my house built for me. So I think the architect's going to be all right for a little while, and
And
same with
hopefully we
us,
will be too. Yeah.
hopefully.
No, I mean, I love AI. It's made everything so much more accessible, but at the end of the
Yeah.
day, people still need direction and want the kind of hand holding and knowing what's happening. So speaking of hand holding here, the quarterly things that we would recommend you do. So we're getting close to the end of Q1. So file your extensions, make sure you understand what your budgets are for the year, but get ready for your Q1 payment, which will be happening April 15th. And this is all thinking that your books are being done and clean throughout the year. But in Q2, file your 25 returns or finalize with an extension. Make sure you understand how Q1 actually did for you, because that's what your Q2 estimated payment would be, based off of. We want to be using these real-time numbers. Make your Q2 estimated payment. Get ready for end of year. If there's once you move into Q3, this is a great time to start thinking about if you're making a lot of profit and maybe you need some new equipment or the things you should be buying, start thinking about if you want to start getting into, we get a lot of real estate conversations at the end of the year for people who want to buy a short-term rental or do something in their portfolio. You got to get started thinking about that earlier. I had a client who I talked to in November who wanted to buy a short-term rental before the end of the year, and it just like wasn't going to happen. Make your Q3 estimated payment. Q4 is our busiest time of year, which is hilarious because you'd think that April and October, or March, April, even September, October, but end of the year is when really crunch time comes because those are the times you have to make sure that you have finalized your salary, that you have made those started that 401k that Mitchell was talking about earlier, that you've done that you've made all the purchases for things you need to before the end of the year. So getting prepared and being
Uh,
on top of everything throughout the year really gets you to where you're not, scrambling in Q4.
yeah, and Q4 is our Super Bowl because it's all new clients who are not doing what they have to do. It's not our clients that are freaking out because we've already handled that. We got to wind this down because we've gone over time. I mean, we
Yep.
really appreciate all you taking the time. Um, and yeah, we provide this service to folks. You can 50% off setup fees for webinar attendees. You can get on a call with us. You can get on a call with Evan, and we can figure out if we're not right or if we are right for you. If we're not right for you, that's okay too. We can point you in a great direction, you know?
Yeah. Well, thank you guys for all attending. Really, really appreciate it.
Yeah, and thanks for staying till the end. This is awesome. We appreciate it.